The market saw some wild strings last week, hitting its head on this trend line resistance here, but still managed to close the week up 0.3%. But more importantly, a break of the 6,700 here could push the markets higher this week. Let's discuss why. My name is Dan Slim, and welcome to another episode of Monday Market Outlook. So manufacturing PMI numbers were announced last week, and it came in at 50.9. This marks the fifth straight month of manufacturing expansion, and with this result, we rank 29th out of 215 countries, and we have actually grown an average of 4.5% in the past 10 years. So food manufacturing is still the top sector, comprising half of the manufacturing index, and it's worth to note that manufacturing is worth 20% of our GDP. So the 50.9 manufacturing index puts us at number 2 amongst our Southeast Asian neighbors, with Indonesia on top at 52.9. But meanwhile, across the globe, full-year GDPs are slowly coming in, but there's trouble in the European zone as most European countries are struggling with their economy. Only Spain is the outlier and has managed to grow 2.5% last year, with analysts seeing this momentum to carry over to this year. However, the European Union's biggest economy, Germany, is contracting with a negative 0.2% GDP in December and a negative 0.3 GDP for the whole of 2023. In addition to that, France, which is EU's second largest economy, remains stagnant at 0% growth in the fourth quarter, but still managed to grow 0.9% last year. So looking at some of the European countries that have reported, we can see quite disappointing GDP results for the European zone. But the global economy still looks poised to experience a soft landing, as many believe that we've seen the worst, and as inflation starts to ease, we can probably see a baseline growth of around 3.1% for this year. Where will the growth come from, right? Not in the US, as they will continue to see slow growth rate as they can still feel the lag effects of a tight monetary policy. Also not in China, where they will continue to experience weak demand. Europe may see a slight rebound next year, but it is really in the Brazil, India, and Southeast Asia where we can see some growth accelerating in 2024, and this includes the Philippines. And if we look at the full year GDP growth of Asian countries, we can see the Philippines in the driver's seat with 5.6% growth rate, which is the highest in the Asia region. Of course, we're not counting the Uzbekistan and the Kyrgyzstans of this world, right? So congratulations, Philippines. So this has sparked growth revisions from different agencies like the IMF, which sees the Philippines growing by 6%, up from the 5.9% forecast, reflecting a slightly stronger recovery in investment and exports. So we are expected again to lead the region this year. Meanwhile, the World Bank, in its latest outlook, is also expecting the Philippines to lead the region in terms of GDP growth at 5.8% in 2024. And this is probably the reason why the PSEI continues to rally this week, breaking through the 6,700 resistance level to end the week slightly higher at 6,707. So hopefully we can see a continuation of this rally all the way to this long-term downtrend line, and a breakout here could mean a consolidation along this upper band. If not, we can expect the markets to probably consolidate here at the 6,700 to 6,600 level. So we will see some heavy economic numbers this week, starting with the inflation numbers on Tuesday, unemployment rate, and the industrial production numbers on Wednesday. So the economic results this week will determine how the markets will react in the coming days, as inflation is expected to ease to 3.1%. We hope that it could help the markets continue this rally and hopefully break out of this downtrend line. So let's take a quick look at some select issues. Let's start with Ayala Corp. Still experiencing some chop as we continue to see the effects of the Mitsubishi sell-off. The 696 zone continues to provide key resistance to AC, and we could see limited upside for now. No? So far, it's still above the 200-day EMA, but you see here the lower high and the lower low here could be a sign of bad things to come. No? On the other hand, we mentioned that ASM may be the better choice for this year. It has formed a higher high and a higher low, and the 50-day EMA continues to hold nicely. So look for 948 as its next resistance zone. So far, things are looking good for SM as we see the 50-day EMA and the 200-day EMA form a golden cross. So JFC retreating beyond the 20-day EMA to 250. Uptrend is still intact, and the level really to watch out for is 283. The retrace here may be caused by the recent announcement of the declining cattle supply in the US as it's currently at its lowest in 70 years. So this has pushed worldwide cattle prices to recent highs, which may have created a drag on JFC. Next, we have DMC, which broke through the 1072 resistance zone. Could there be a gap fill? Look here, there's a gap fill, potential gap fill here to 1120. Now, we could probably see a consolidation here and a mean reversion to the 20-day EMA before it continues its rally to 1120 if it does. We mentioned that you should not count out MONDE yet, and the stock responded with a convincing breakout past the 200-day EMA to end a spectacular week up 12%. Congratulations if you were able to buy MONDE. So wait for a possible consolidation or a pullback to maybe 9 pesos here before it could probably resume its rally to challenge this major downtrend line. Now, banking stocks are also rallying. BDO breaking out of this consolidation here. Watch out for its reaction at 150. If it breaks out to 150, 155 may be our next target. BPI breaking out of 113. Watch out for its next resistance zone at 120. However, Metrobank lagging behind BPI and BDO as it struggles to break out of this trendline resistance. The divergence here with the oscillators could mean a consolidation is more likely at the 56-57 level. Now, why are banking stocks rallying? So maybe because S&P Global came out last week bullish on the banking sector. Now, improving economic conditions could provide a growth rate of around 10 to 12%, which is significantly up from the 5 to 6% in 2023. So as net margins continue to go down, it seems that credit growth may be the key to sustaining the banking sector for this year. Now, lastly, we have AREIT gapping down to 3150 before recovering to 33 last Friday. Now, same as AC, this created a role reversal where the 200-day EMA now becomes resistance for AC. Now, the problem with AC here is that last week, the Ayala sold 181 million common shares at only 31.10 per share as AREIT scrambles to comply with the required public minimum float requirements. Furthermore, another 9 billion of additional shares are up for a private placement transaction. So with the 181 million shares already sold, AREIT needs to sell 89 million more shares just to meet the minimum required public float. Now, if we look at the historical way that they keep on selling stocks at significant discounts to the market price, no? The question is, how much will they sell the 89 million transaction against its current price? But, you know, at current prices, the dividend yield of AREIT has actually improved to around 7%. So maybe we could look at this overhang as an opportunity to accumulate AREIT as yields improve during these kinds of transactions. So meanwhile, in the US, PMI numbers were also reported last week, which improved to 49.1 up from 47.1 last month. However, as manufacturing continues to contract in the US, this has marked the 15 straight months for US manufacturing contraction, and we can see how this helps the bear case for a US recession. So we can see the same situation here in the 90s, 2000 and 2008, where we have 13 straight months of manufacturing contraction has actually led to a recession, which is represented in the gray areas here. So we have an inverted yield curve and recent highs in the bankruptcy filing in the US, among other similar indicators that reminds us that we should probably be careful in 2024, as we may see an impending recession in the US. So last week, the Fed held rates steady at 5.5%. A slight change in the tone after the J. Powell speech indicated a more dovish Fed moving forward. As such, the probabilities of a March rate cuts has tempered to 20.5%. Remember that this was 80% just a few weeks ago. Now the market is leaning towards a 73% rate cut by May and a whopping 97% rate cut by June, even as much as 50 basis points. So we are seeing some aggressive rate cut probabilities here, up to 150 basis points before the year ends. Perhaps analysts are reading the same recession signals, and they are also expecting the economy to enter into recession by mid-year, because, I mean, let's face it, the Fed doesn't cut rates because they are feeling generous. There has to be a compelling reason for monetary easing, and a recession could be that reason. Now, employment numbers also came in on Friday, again showing a resilient labor market in the US. A ridiculous 353,000 jobs versus 187,000 jobs expected, and a revision on the December numbers from 216,000 to 333,000, right? So we've seen 2 months of strong labor growth. This should be expected as we see hiring surge in preparation for the holidays. Unemployment rate was announced also, and it came in at 3.7%, better than the 3.8 expectations. But it was really about the earnings that moved the markets, as last Tuesday's tech earnings disappointed, but the Thursday earnings more than made up for it with strong guidance from Meta and Amazon. So Meta shares surging 20% after announcing its first dividend and a 25% revenue growth in the last quarter. Amazon also gapping up 7% after its 14% revenue growth, coupled with their optimistic guidance for 2024. Now, this sent the S&P 500 to new highs, ending the week at our initial resistance at 4,950. Tuesday's earnings drawdowns here was instantly reversed last Thursday and Friday after the Meta and Amazon report. Could we go higher? Uptrend is still intact here. Price action continues to bounce off of the 20-day EMA as we continue to grind upwards despite the oversold RSI levels. A continuation of this rally means that we are headed towards probably around 50.28 in the coming weeks. But for this week, there are no significant economic numbers due in the US. So maybe it's up to earnings to move the needle if it can, because the market has been dependent on the Mag 7 stocks for so long. We have the broader markets reporting next week. We have McDonald's and Caterpillar on Monday, followed by Eli Lilly and Spotify on Tuesday. So we also have PayPal and Alibaba on Wednesday, and these are the implied movements with the likes of Palantir, Estee Lauder, Spotify, and Roblox, with possible double-digit movements either way. Let's look at some historical trends as we finish January up 2.3%, and this means that the market tends to move higher during years when January ends positive by as much as 16.8%. And as we zoom into February trends, we do tend to see the markets continue to move upwards, perhaps reaching 5,000 maybe for the S&P by mid-February before a sell-off happens towards the tail end of the month. This tracks well during election years where the sitting president is running, as we do see this green line here peaking in Feb before we encounter weakness well into March and April. So we'll see. That's it for this week. Please like this video if you found the information useful. Subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly. And I'll see you again next week. Bye-bye.